Ladies and gentlemen, okay, and welcome to the Utkarsh Small Finance Bank Q1 FY24 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions when the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that the conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you. Over to you, sir.
Yeah, hi. Thanks, Robin. Good evening, everyone, and welcome to Utkarsh Small Finance Bank Q1 FY24 earnings conference call. On behalf of ICICI Securities, I would like to thank the team for giving us the opportunity to host the earnings call. We have with us Mr. Govind, MD and CEO, Mr. Dev, CFO, and Mr. Head Finance. I would now request Mr. Govind to take us to the Q1 FY24 highlight, and then we'll open the floor to Q&A. Over to you, sir.
Thank you, Renish. Thanks for this introduction. Good evening, ladies and gentlemen, on behalf of Utkarsh Small Finance Bank Limited, and thank you everyone for taking out time to attend our investor call post IPO. At the outside, I want to express gratitude to everyone for making our IPO a grand success. As you are aware that we started this journey as a microfinance company in September 2009 from Varanasi and got small finance bank license in 2016 and commenced our banking operations from January 2017. And as you are aware, now we are a listed bank. We started from Varanasi as there are significant opportunities in surrounding geographies of UP and Bihar, considering the significant under-penetration of financial products in that geography. Coming to our Q1 FY24 numbers, we have witnessed a healthy business growth and operating environment during the quarter. Our loan book and deposits grew by 31.4% and 35.6% year-on-year respectively. In terms of loan composition, we continue to build our microfinance franchise back of strong understanding of our core geographies and our rural and semi-urban franchise. Around 85% of our microbanking branches are in rural and urban locations, which provide us competitive edge to build microfinance in under-penetrated geographies. We have added 50 microbanking branches in Q1 of FY24 and overall close to 100 microbanking branches over the last 1 year. We were a little cautious in customer acquisition during COVID phase, with normalcy, in operating environment from FY23. Is back on acquiring customers. Number of customers have grown by 2.5% quarter-on-quarter during this period. The slower disbursement in current quarter in microfinance sector is one of technical reasons. Pipeline for our subsequent loan cycle was lower in this quarter. Normally, more than 3 lakh customers are due for final loan maturity in each quarter, while in Q1 FY24 it was less than 1 lakh customers, as disbursement were low in Q1 FY22 on account of COVID, and more than 5% of our book is with 2-year maturity. Our individual loan product, which we say MBIL, to existing mature LG customers, continue traction with year-on-year growth of more than 150%, strong asset quality of less than 0.5% cross NP. Build digital experience for our microfinance customers who come digital onboarding, e-sign, KYC, digital collections, customer-specific QR code, micro ATM, and other offerings. We continue to build our differentiated branch strategy, that is microbanking branches, focusing more on microfinance business in rural and semi-urban locations, and general banking branches primarily in metro and urban locations, and focusing more on deposit acquisition and other retail assets built up. There is significant potential to cover other assets like MSME, HL through our microfinance franchise, which we are exploring as these products are maturing. Our differentiated branch strategy not only helps us in offering relevant products to our customers, but also helps ensuring cost efficiency of our operations. We are also building our retail loan products, which are MSME, home loans, and deals. For MSME lending, currently we are operating from around 80 odd outlets, in significant headroom available to expand within existing franchise. Our core geography has significant potential product. After getting experience and having a book of more than 700 crores as of now, we have confidence of building this further in little more formal and under-penetrated segment. We have introduced micro lab products and over time expect granularity and yield of this book to continue. Currently, more than 94% of our MSME loan book is secured loans. In the loan segment as well, we are operating only in one notch or half a notch below the prime customers. As we build experience, we would bring our presence more in informal and under-penetrated segments. We have deep franchise available in our core geographies as well as other target states to build this further. This deal segment as well started from our core geography of Uttar Pradesh, extended to Bihar, Jharkhand, and NCR, began through SCV segment, and now deepening our presence in LCV segment as well as used CV segment. Overall, we will continue with our strategy of starting the journey from our core geographies and then replicate, build the same in other geographies. The wholesale lending segment, we are focusing more on this small ticket SME lending, where you can say average size of less than 5 crore, wherein sole bank meet working capital funding and securing our exposure through a hard collateral cover of over 100% in all cases. Lending continue to operate primarily in entities rates in A or above or higher rate by external rating agencies. There are delinquencies in our wholesale lending. On the liability side, we have expanded our franchise significantly. We have opened 64 general banking branches over last 1 year and more than 110 general banking branches over last 2 years. Out of total 257 general banking branches, currently around 4% branches are less than 2 years vintage. Believe we will gain significantly over time as these branches mature. As a strategy, we want to be top 100 for liability acquisition. We have seen good growth in retail deposits year on year as well as in quarter on quarter basis. CASA growth and CASA share impact was more on account of interest rate environment. We expect this to build as branches mature. Maintain tight control on institutional deposit as we are having surplus liquidity of more than 2,000 crores as on June 30, 2020, and because of which overall quarter-on-quarter deposit growth was around 2%. Year-on-year deposit growth was healthy at 30%. Build experience of customers through digital onboarding. More than 95% of light customers are onboarded. Digital onboarding Q1 of FY24. We were the first small finance bank to launch UPI Lite for our customers. The liability segment, there is significant scope in our home market. We have a strategy of building a significant market share in some of our home markets like Varanasi, Patna, Prayagraj, etc. All these have positive potential. Furthermore, we are continuously working on granularity of and broad basing of our institutional deposit profile. Our concentration of deposit declined from 8% March 22 to 21% as on March 23. We have raised a good capital of 500 crores through IPO. With this, we have sufficient capital available for our growth plan. Overall, we are witnessing stable financial performance as reflected in ROA and ROE of 2.3% and 21.1% respectively, and successfully building on our strategies of creating stronger franchise for our microfinance business as well as MSME lending, housing loan and skills lending. We have rolled out salary increments for employees from April 1 last year. We did from 1st of July, and to that extent, with additional cost in the quarter. We continue to invest in our people, presence, process, products, and technology. Our last 2 years, we have opened more than 270 branches and expanded our franchise. We will look to significantly scale up branches over next 1 to 2 years. On our medium to long-term strategy, we would like to highlight following. Microfinance remains our core business for us, and we think that still, we're more than 50% of our portfolio at the end of FY26. And within microfinance, microbanking individual loans, which are mature customers could gain scale and be close to double contribution, considering large jail customer base. our loan book growth, which was 31% for last 1 year, deposit growth of 36% year on year, a big growth opportunity in our businesses and geographies, and to that extent, growth they remain in the same trajectory. Cost income ratio, we expect that it will be in the same trajectory what we had FY20. In terms of ROA and ROE, I think we expect ROE will certainly be above 2%, and ROE will change of around 20% of this next 1 to 2 years time. That is what we are expecting. This is from my side, and my colleagues want to add, we can do. Otherwise, we are open for question answers.
Thank you, Govindji. I will implement a few points along the commentary that Govindji gave. Clearly, the Utkarsh Small Finance platform over the last 7 years, and also bringing in more than 14 years of microfinance experience into the bank. And with this capital that we have recently raised, helps us to augment our expansion plans and stay on our strength with the opportunities available here from. 2 specific points I would supplement for those that we are very firm on our focus to continuing bringing banking services solution to the underserved and underserved customers in the rural and semi-urban segment, and we see a longer growth and profitability path from here. Also, point number 3 to supplement before I give you the little granular details of the financial performance for quarter on quarter, is our liability franchise that we are operating to 257 general banking branches in the top 100 cities, complements well with our secured book expansion that we are doing through these branches. Now, let me quickly take you to the quarter-on-quarter results on a year-on-year basis for June 23. What I will do is very quickly run past the key performance indicators, and I have broken up this into 4 buckets: operations, capital, asset quality, and profitability. On the operations front, we are currently operating with 851 branches, which we call banking outlets. So these branches were 190 immediately at the previous year and quarter. We have added 161 branches in last 1 year from the end of previous quarter to current quarter. Our headcount was 13,300 previous quarter year end, which is current quarter is 15,900. We almost 2,600 employees. The point I'm trying to drive is there is investment in people, others well, as we see pre-COVID doors coming back and business coming back as usual atmosphere. Our total gross loan portfolio as on Q1 FY24 was 14,394 crores against 10,951 crores, a 31% YOY growth. The mix of the gross loan portfolio was 75% micro banking and 25% non-micro banking, which is primarily your book last quarter end. This year, current quarter, June 23, the mix while we focus on establishing and more penetration in our micro banking, we also see that our secured advances are growing at much faster pace on a lower pace, and therefore the current mix is 3% micro banking and 37% non-micro banking, which is primarily materially a sector book. Our total deposits as of current quarter end June 2023, 13,967 crores against 10,297 crores, a YOY increase of 36%. Our CASA on a standalone deposit basis has grown 20% year on year, and our retail term deposit on a standalone basis has grown over 51%. However, the CASA to the total portfolio as on June 2023 is at around 20%, and CASA plus RTD is at around 62%. What we believe is that this 257 general banking branches, out of which Govindji mentioned, the 64 we have created over the last year and another 50 odd which we have created a year back, are the branch which will mature and give us momentum and traction in our CASA deposit and RTD, such that we believe that efforts around 3 years' time, we should inch up the CASA to the 35% and CASA and RTD to 75 to 8% as we grow our base of advances and deposits. On the capital front, our net worth is 1,110 crores. Our capital adequacy ratio as on June 2023 quarter end is 19.83. We have not added the profit that we have earned in this quarter of 107 net after tax. If we add this profit, our capital adequacy ratio stands at 20.88%. Coming back to the third bullet, which is asset quality, our gross NPA has been improving quarter on quarter, which is at 3.13% as of the June quarter 2023, which is significantly improved our 5.73% as the quarter end, and it has also improved our Q4 to 3.23%, and our net NPA is up 0.5%, which is at 0.33%. Improved our 1.66% on the previous same quarter, and it has improved Q-on-Q also from 0.39%. Our provisioning coverage ratio is at 90%. My last bucket of performance, I would speak about the profitability. We have got a profit of 107 crores in the current quarter against 89 crores comparable previous quarter, which is a rise of 20%. Our yield on advances for the current quarter is 18.8%. Net interest margin is 9.16%, and cost of funds is around 7.55%. If I subtract yield on advances at 18.8 to my cost of funds, which is 7.55, we are operating in the current quarter at a spread of 11.25%. I would also wish to draw your attention to slide 27 in the investor presentation, where we have given quarter-on-quarter trajectory of these three ratios. You will see on the yield basis at a strike base 19%, we are almost 90% through the 5 quarters that we have shown. Cost of funds at a strike of 7% plus minus 25 basis points is a consistent around the same numbers around the 5 quarters, and NIM also is consistently that it's not gone down by below 9% over the last 4 quarters trajectory. Now quickly moving into cost to income ratio. Cost to income ratio is 67% for the current quarter. If you really look at and 51% previous quarter, one would look at it that it has changed up, but there are 2 points that I would like to clarify. One, that we have established the branch of 161 new branches this quarter, and our addition of headcount, all the cost is loaded in the current quarter because this happened from the end of previous quarter to the current quarter. Also the fact that we have yet to harvest the benefits of passing on the hardening of the interest rate to our banking book. We are operating currently on our GSG portfolio at 25%, which was on the previous quarter at 53%. So while we go and do disbursement at a higher yield, 5%, including the yield on other products at a higher yield compared to the previous year, and do productivity measures, we will see cost to income ratio also improve. But while we also continue to invest in our technology, which will be a spread of around 54% to 55% range of our cost to income ratio. Kunji mentioned about return on average is 0.27%. Again, on the slide 27, we have seen that the return on average has always been upward 2%, and return on equity has also been upward 20%, which is 21.05 at the June quarter end. Lastly, before we begin, while this is the first call after the IPO, so I wanted to set the symbol. I'm sure there is curiosity on the system for high vertical, but lastly, we would want to say that during the COVID period, FY21-23, we were growing at a CAGR of 28%. Another learning that we have got into the financials from the COVID era, as we know that the micro banking, that is actually the highest intent of payment, but swan event like COVID does get a stress. The outcome of that learning is that we are creating an additional provision in the financial year 23-24 and continue to do, done in 22-23 and continue to do in 23-24, which was 1% of our JLG book as overlay provision over and above the IRAC norms, which was 80 crore of provision done in 22-23, and we expect to do 1.5% of our JLG book, micro book, as on March 23, which is leading us to about 106 crore of provision as of June quarter, over and above the IRAC provisions. With this, I think reiterating the fact that we would wish to keep our KPIs around the minimum of 9%, ROE 2%, and ROE 30% around, ROE of 2% and around 9%. Our business model is being structured to see that we continue to give consistent performance. Thank you for joining us. Thank you for making us more aware. I'm sure you are looking forward for some Q&A, and we will take those questions once again.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, press star and one on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue is. First question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, sir, congratulations on good performance and thank you for taking my question. So, sir, my first question is on micro banking portfolio. So, while you explained why the growth was soft in the quarter, so how growth for the full year? And again, on asset quality in micro banking, we haven't seen much improvement in buckets despite we have done some material write-off quarter. So, is it the case that our PAR is higher? So, as I see, I mean, our PAR seems to be slightly higher than our peers, despite putting in better markets of Bihar. If you explain this.
Okay. So as far as growth part is concerned, we expect our usual growth to be around 20%. And in especially the JLG part, if you look at, that's what we expect. I mean, industry does talk of maybe a little higher growth also, especially because our ticket size is more controlled than many of the players in such team. We expect that's the range. I'm talking of JLG this year. The growth will be in the range of 20%. As we mentioned during our first interaction, that they're also focusing more on the MPIL, which is individual lending product, where we are expecting a faster growth. Because one reason is that it's a low base also. We have around 387 crore at the end of June. So do we expect that this will have a more than 150% growth, if you look at this financial year. But overall, 20% odd growth is what we expect in JLG on a medium-term horizon, from our side. In terms of slippages or in terms of PAR numbers were, you can say a little higher if you look at quarter one angle. But overall, I think we are seeing a good significant improvement across. And from our senses, if you exclude the write-off cases or the NP cases, there are demands from those cases also. Our overall collections is in the range of 98.5%. The net looks 97%, but 98.5%. We expect that this will improve from here by maybe another 5.5% or so quarter two. So overall, whatever numbers you are seeing for quarter one, with significant reduction in quarter two across, in fact, significant improvement or in portfolio and significant decline in the overall stress or overall NP numbers for quarter two.
Okay, sir. And the second question is on new products, the retail, your MSME, housing, CPC. So when I look at pricing, the pricing is almost near the prime customer pricing. But when I look at our performance on a lag basis, say 1 year, 2 year basis, our NPL seems to be slightly elevated versus the pricing we charge. So then how are we looking at contribution from these products in terms of profitability over the term? There are some significant contributors and by when?
So we expect that in next 18 to 24 months time, one is that all be contributing in the bottom line also. They are contributing top line, but they will contribute in the bottom line also. That is one part. Second, you rightly mentioned that we started this Alpha with a prime customer, but near prime. I mean, these are maybe one notch lower best of the banks are offering. And that is why maybe our returns are still lower than some of the peer group. But after getting experience of last few years time, and you can see now we have got a case in whether we talk of affordable housing or whether it's fields, and we talk of MSME also. Now we have close to 3,000 crore overall book from these segments. Now we are also going to you can say more granular and also a little one notch lower also, and we expect that our returns that is also starting happening gradually, because in overall balance sheet it will not be given, but that has always started happening. So our growth in terms of overall RO, the return on these portfolios going to grow from here. And at the same time, you also mentioned about this, stress in cases. When we started in some of the pockets or some of the cases, there is no pattern for this. But in some of the cases, when you initially start start this, there may be some issues, and I mean that is also reflected because overall the book size is small. We don't expect any surprises, as I mentioned. In this also we expect a much lower you can say NPA numbers or DPD numbers going forward. Even in quarter two, significant reduction in the overall whatever slippages we have seen in the loans also. One, the growth rate will improve from here. The yield will certainly also improve because gradually we are able to pass on cost to the customers. And overall, the slippages or the overall NP numbers will come down from here. So all these will contribute. And as I mentioned, in next 18-24 months time, we expect a significant contribution of all these three verticals which we have started during last 3-4 years time in the overall bottom line of the bank also.
All right, sir. Thank you so much for answering my questions and best of luck.
Thank you.
Thank you. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi. Good evening, sir. Thanks for my question and congratulations on successful list. So I have three questions. Firstly, on overall growth, while you guided for the JLG to grow 20%, and within that, I mean, if I look at the overall book, do you see 30% kind of growth?
Yes, certainly yes. As I mentioned, our AUM growth has been in 31%. Even CAGR for last few years, if we look at 3 years time, it is around 26-27. So we are confident that 31% is shade up, better only, and it will not go beyond and below this. At least when you are looking at next, 2 to 3 years horizon, for sure. And the way you also mentioned, Gaurav, 20% comes from micro banking part, and because in other asset classes our base is low, so the growth rate for those asset classes is higher. So on a blend, certainly it will be above 31% what we have achieved during last financial year.
Sure. Thanks. So the question is with regards to margin, and here I would like to look at the points that you have shared in the presentation. The cost of funds has increased to 7.6. Within that, I just want, and you mentioned cost of deposits, cost of term deposit is at 7.9. So is the repricing completely done, and whatever rate hikes that has happened, or is it completely reflecting in that 7.6 cost fund that we, is some batch of these would come up pricing in the next couple of quarters?
So Gaurav, basically, we will take this into the institutional term deposits and the retail term deposits. So repricing on institutional term deposits is largely over. On the retail term deposits, we have, let's say, a broader maturity of about 20 months, 24 months. So on retail piece, about half of the term deposit repricing has happened. The balance half maybe would happen over next 2-3 quarters.
Okay. So by you're saying by Q3 you should see cost of funds.
That's correct.
Okay. And let's say from 7 points, will it be like a basis point, or will it be higher than, let's say, cost of funds that we are seeing today? 7 point, that should, based on your calculation.
It should be below 8%. This is our sense.
Okay. Understood. And on the yield side, simultaneously, if the growth trajectory in this year, you're seeing the JLG book will grow at 20 and meaning portfolio will grow much. The share of microfinance will come off. So in that context, what kind of yield should we look at? And also on pricing of the MFI, has that we first create a card rate to the engine norms, and now if we are allowed pricing, have you changed the yield in the MFI book? And yes, what kind of repricing is left in the MFI book?
Right. So considering the hardened interest rate cycle, Gaurav, we had increased lending rate in microfinance by 1% from November 22 and by additional 1% from 1st of April 2023. So as of now, the repricing hasn't happened. So if you see only about 20% of our book at current rate of interest, balance 8% is basically 1% lower. I mean, 40% is 1% lower, and additional 40% is 2% lower. So maybe in about 9 months to a year time, we would see microfinance lending yield improving by at least 100 basis points from where we are as of now. And second, just to clarify on the microfinance, basically what we are saying, the JLG growth is about 20%. MBIL growth would obviously higher on a smaller base. So overall, micro lending fees may grow by, let's say, 22-23%. And both the pieces as of now are running at the same rate of interest. So to that extent, this will support overall yield on advances.
Understood. So is it fair to assume that over let's say 1 year, whatever in cost funds that we see or that we see in coming years, that could be partially or fully offset by the improving yield? So next on
fully actually, fully, not even partially, fully offset.
Okay. So 9-point margin that we've seen broadly, we will gain for full year FY24.
Yeah. Actually, it will go up. Gaurav, it will go up. I mean, 9.2, I'll say it's a lower side, because of we had a lot of expenses new expenses during quarter one, and it will start giving yield results in next quarter to quarter three. So we expect that this will go up, and this may be in the range of 9.4 to 9.5 for sure for this full year.
Also, Gaurav, due to our hi Gaurav, this is Sarju, and I was adding up that also on account of the fact that we have this capital which is coming and our CR has improved significantly in the higher rating. I think our cost of funds, which should on the refinance side, should be able to refinance or reprice it favorable to the bank. So that should also play an upward effect.
Sure. And just the final question on asset quality and just Rajiv's question, is there any seasonality slippages that we see in 1Q for your portfolio, and hence you're saying that hence you're saying that in 23 this stress will moderate?
There was specific seasonality, maybe some pockets and some we had some delays, and as I mentioned, the activity level was little lower. Not the seasonality, barring very small portion. But we are seeing that in many cases we are collection happening, or the collection for where which are already under DPT, there is a significant improvement on the lines of what has happened last year. So we do expect that you might see that there is an elevated look at NPA or overall credit cost number. This will come significantly lower than what we have seen in quarter one. If you look at the whole year, we expect that credit cost to be in say 2% or so, and is what we are confident of.
Sure. Includes floating provisions, whatever we make.
Yes. Yeah. So whatever number give, even for month or quarter, floating provision is part of the cost.
So if the floating provision is around 1 slightly higher than 1 of the FY, at the end of the year, you are saying it will be 1.5 FY book. Correct.
So, but just to clarify, it will be around close to 135 crore only for JLG, and then there is some statutory requirement also. It should be 150 crore or so, a few crore here and there at the end of March 24.
Okay, understood. So this that was guidance includes additional 45 crore that will be making.
Absolutely correct.
Great. Understood. Thanks a lot, and all the very best.
Yeah. Thanks, Gaurav.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press *1. The next question is from the line of Nilesh Jetani from BOI Mutual Fund. Please go ahead.
Hi, good evening, gentlemen, and thanks for the opportunity. So first question was on the collections and any delinquencies are you seeing in North India, considering the flood situation? So any pockets or any regions where we are facing any difficulties in collection?
So far, the pockets where we are having our microfinance portfolio, we have not faced any delinquency. We had some days, one of the reasons why there are some slippages we had in handling some of the repossessed vehicles and those type of things. That's a very small isolated place. But if you look from overall our business and more importantly microfinance, our entire geography is not having any issue as far as the floods are concerned. The geography which we cater to, so there's no impact of floods this year so far. Obviously we don't expect future also, because it's already first week of August is over. This year we don't expect any impact even temporary, which is normally temporary, any impact of floods this year.
Good, sir. That was really helpful. And sir, one piece on the contingent liability. So today, on the provision, what kind of provisions do we carry on the?
So if you see, we have an additional provision of about 106 crore and standard provision which is little higher than what is required as per RBI norms. So overall standard provision we had about 65 crore.
Got it. And one last from a deep dive. So when I draw parallels from other banks, from a mid-sized bank, many of them have been talking about we would like to reduce the share of gold loan or X category of loans, but it hasn't been the case. What gives us confidence that we might go slow as far as the MFI is concerned, that piece will grow at 20? Very penetrated in our regions, or we are going slow in particular kind of category of loans? Just wanted to understand the broad perspective of 5-year timeline.
So one thing, we are not going slow in microfinance. I think 20% growth with a base, we have 26 lakh customer base. Our idea is this is reasonable growth, and we keep repeating that, this micro banking individual lending, that is what we see in the future. Customer are mature customers with, 5-7 years stand. So that portion we will go faster. So we are not looking any, lower growth of microfinance. Our ticket size is normally lower than industry history, and one of the important reason is that we are more in the central and rural area. So we are not, microfinance is one thing we understand the best. Always we focus on microfinance for sure. Right? We may not be looking that much in like gold loan. Our sweet spot will be more about the smaller ticket size loans and the MSME segment, the affordable housing segment, field segment, where I think, especially the geography which understands the best, there is a good demand, and we can do really good in those few segments. So if you are talking of 3 to 5 year horizon, obviously things will, evolve over a period of time. But besides microfinance, MSME, housing, that too, largely affordable housing, wheels, and the small corporate base where we are able to give, collateral-based loans, hard collateral-based loans, and where the customer becomes our primary customer for working capital. These are 3 or 4 which will be focus area. We'll have product improvement in this. For example, we have started micro lab. We started with the normal lab, but we are also looking at micro lab. Especially there's a big market we can see in our core geography of UP, Bihar, Jharkhand, Chhattisgarh, micro lab, and we have not done unsecured lending. We have done limited unsecured lending. We are re-looking at unsecured lending so that our yields can go little better. This is how the type of composition of at least lending we are looking at. Gold we are not looking at aggressively because anyway we are not seeing gold, overall also on industry level growing that much. Important point is that one of the important for us remains that we are differentiator in terms of the geography will always helpful to us. We all are aware that there is around 1% overall for Bihar type of states which is almost 9 crore plus population. UP is around 2% of overall credit. So I think we see a good opportunity in these. After becoming bank, I think we have seen good growth in other verticals also like microfinance.
Got it. That was helpful. So one question on ROE 3. So we are moving from a MF5 category of loan, which is a 20-21% yielding loan, to other categories of loan where yields could range anywhere between 13, 17, 18%. From a ROA perspective and to maintain the current ROA, what kind of costs are we expecting the regions where we operate, state of Bihar, UP? Even if you move our sector of AUMs into some other categories, what kind of credit cost do you anticipate? Not from now, but the mix significantly change from MFI to other categories.
So the way we look at it for financial year 24, we are talking about a credit cost of sub 2%. And as let's say the portfolio moves more in favor of the third businesses like MSME, HL, right? The credit cost, it will come down, and another leverage to ROE 3 would be the cost income ratio, or let's say the operating cost. Obviously, the operating cost for micro business is higher. And these businesses also, which are new, let's say MSME, HL, processes which we have set up, the teams which we have set up, it will higher. So this cost will also come down. As these businesses get scaled up. From ROE perspective, both these three contributors, one is lower credit cost, maybe by 30-40 basis points as business mix is changing, an additional 30-40 basis points coming down because of, again, the lower cost in the MSME, HL and the other businesses.
Got it, sir. So that was really helpful. And one last from my side, historically, banks which are largely MFI heavy, really have some shocks and they see some provisions going up, maybe not every year, but every third or fourth year. So according to you, at what mix of MFI we believe that volatility provision number will go off?
So one thing, if you see, we have done at least create this provision buffer. The thought process behind this provision buffer is really to basically, let's say, come out of this vulnerability or volatility in the provisioning requirement. So what we think, basically, we should definitely set aside something every year from our normal profitability to a buffer, let's say if there is a event kind of a risk. So that this uncertainty from a higher provisioning perspective or impact on profitability perspective goes out from P&L and balance sheet. And secondly, as you also said, as we are moving, let's say, more diversified loan book, which is, let's say, both secured and unsecured mix, the right mix anyways will help us in, let's say, the volatility little less than what probably we have seen, let's say, in a portfolio which was about 90% microfinance. So both these will help us to a very large extent in terms of this volatility in provisioning and the profitability.
What then? What would be a write-off policy? 270 days, 5.
So write-off in unsecured, which is the microfinance segment, we basically do write-off once NPA is more than 1 year and there is no significant collection. And obviously in a secured business, we assess write-off basis security available to us, basis collection effort, basis collection feedback.
Got it, sir. So thank you so much for replying to all of them and all the for the future quarters.
Thank you.
Thank you. Participants, to ask the question, please press star and 1. The next question is from the line of Maruti Nandan Sharda from, is an individual investor. Go ahead.
Hi, good evening. Congratulations to management for great set of numbers and thank you for taking my question. I want to understand that the amount which we are writing off every year, I see majorly on account of secured loans. So if I compare this with average loan book, average unsecured loan book, what percentage it will be, and what is the industry for this? And then one more question in addition to this is this: once we write off these loans of books, what's the probability of recovering it back in the getting it back in the system? Based on your last, let's say, 5-10 years experience, what all these things? Thank you.
Okay. So your second question first, basically, which is the recovery prospect from the return of pool. So what we have seen so far is there is recovery of about 15%, which even from the write-off pool. So whatever we written off during the demonetization period, or let's say now in the COVID period, essentially we have seen about 15-20% collection eventually coming over a period of 3 years. And second, I mean, from a, let's say, the write-off as in relation to the overall loan book. So obviously during the COVID period is little higher, but if you go back, let's say the before COVID period, our credit costs and write-offs were less than 1%, even when our book was about 9% unsecured. So what write-off we have seen in, let's say, in 23 and now basically, which is coming from COVID. So on an average basis, as we are highlighted, collection efficiency in microfinance business on the regular contract have moved to about 98.5%. And so to that extent, in a normal business environment, not a significant proportion or percentage is expected to be written off.
Oh, great. And I have one more question, which is regarding, a longer time frame, next 3 to 5 years timeline. Can you grow business CAGR of like minimum 25 to 30% in basis?
Certainly, if you look at the medium-term horizon, what we are talking at 4 years, and certainly yes. As I mentioned, we are growing. We have grown last year 31% plus, and we expect this year growth should be higher than that. So if you look at a CAGR for next maybe 3 years or so, certainly 25 to 30% is still doable. And we have created enough machines for doing that during the last 3-4 years time. The new verticals we have created and the type of machines we have created and the type of geography we operate where the immense requirement opportunity, I think 25 to 30% on a medium-term basis is not a challenge.
Wow. That's great to hear from you guys, and you guys are doing really fantastic work. And I wish you all the best. Thank you for answering my question in detail. Thank you.
Thank you, sir.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi, team. Good evening and congratulations. Couple of questions from my side. Firstly, on the deposits front, you mentioned that you are looking at targeting some of these urban centers like Patna, Varanasi, and Prayagraj. Can you talk traction on deposit acquisition here? Maybe you can share some numbers around what the market share currently have on deposits in these sectors, and where do you expect that market share to go from here?
So what has happened, initially when we started our liability franchise, we were focusing this area as well as the entire country. We are in 26 UPs. But we later realized that obviously what happens typically in case of deposit, we get a much bigger number from the geography, and I say UP, Bihar and that area, because we are there for a long time. And we go to other places like it is Maharashtra or NCR or Chandigarh and Jaipur type of places. There we have less number of accounts, ticket size is higher. That is how those deposits have happened. Maybe around 1.5 years earlier, we realized that some of the geography where we are deep and where we have good brand because of our we are there for last 15 years now. We should focus more upon these geography. So currently we have some branches and the penetration level of the market share in terms of deposits is less than 1% also, because we are in bank a longer time to build value in these accounts. Our idea is in places like Prayagraj or Patna, Varanasi, even we are talking about places like Dehradun and Gorakhpur, adding to some of these centers. We expect that we should be able to reach around 2 to 3% market share in next 1.5 years time at these places. We have put specialized teams in those places so that we can acquire customers. We can, in a very focused way, we can acquire customers. We are trying to do more marketing activities. So that, especially I'm talking retail side. Because wholesale, sometimes we are not competing in wholesale in this area. I'm talking of the retail side, and that is what we are doing. We have a larger sales team we have placed in these places where we acquire more and more customers, and also there is a big focus on the value accretion in the existing accounts. So our idea is that next maybe 18 months or so, we should be able to have 2 to 3% of retail market share in some of the markets.
Thank you. Question on the loans front. If I look at the geography-wise, the micro around 70% of the book is from UP and Bihar. How do you expect that share to change over time?
So what is happening, we have seen some changes in this market. So if you break into two parts, one is the value and second is the number of customers. The number of customers is coming down faster than value for a certain region, because we started UP and then we started Bihar. So these are the oldest geography for us. There's a ticket size of the people because they have taken cycles, even 8 and 9 cycle also. The size for this area is bigger. So that is why the in terms of overall amount, this is coming down, whereas in terms of number of customers, coming down faster than values. We don't expect much significant reduction if you look at only microfinance case. Overall, we look at the overall my advances, then obviously it will come down faster. If you look at only microfinance, you take account state lower than this, because UP is a large state and we are only currently in the eastern UP only, and we don't intend to really go in terms of market below this. So currently we are not even 1/3 of UP that we cover for. In case of Bihar, we expect that around 3 to 4% decline in next maybe 1 to 1.5 years as far as the value of concern. Because we are seeing now subsequent cycle loans are coming from new states like Odisha or some of the states which we have serviced for last years like Jharkhand or Chhattisgarh, some pockets of Madhya Pradesh, and lastly states of Rajasthan also. they come down by 3 to 4% in case of Bihar, and maybe around not more than 1.5% for state of UP. That is in terms of value, what I'm talking of.
Okay, sir. Thank you. One last question. If you can share the proportion of your banking customers who are unique to us, proportion of customers who are currently borrowing from one other lender to other lenders and so on, if you have those numbers handy.
So broadly speaking, we have around 25%, more than 25 customers, and who are unique clients to Utkarsh. That is the number we have got. And I don't think that they are.
Yeah, so basically about 25% customers are unique to us. An additional about 40-45 customers are basically Utkarsh plus one. And if it's the overall Utkarsh plus two, which is the three lender mix, which is about close to 95-96%, and balance 5% pieces, the 3 plus.
Okay. Thank you, sir. Thank you, Puneet.
Yeah. Thank you.
Thank you. The next question is from the line of Manish Dhariwal from Future Capital Advisors. Please go ahead.
Oh, shucks. Thank you so much. Apparently my phone's cutting off.
Current participant in the queue seems to have dropped the question queue. We will proceed with the next question, which will be from the line of Shailesh L. Kanani from Centrum Broking. Please go ahead.
Congratulations, sir, for a good set of numbers, and thanks for the opportunity. Sir, I had only one question with respect to reverse merger. Any timeline on that, and way forward, given that a holding company is an unlisted company? So if you could shed some light on that.
So, this is little, thing which is not yet, I'll use the word, where the decision has been taken or where it has been, thought through completely. And the whole board as well as the bank board intend to explore this possibility and consider whether and when to do this part. So there is no final decision taken on this part, so I may not be able to go beyond that as far as further discussion. Certainly, now RBI says that 26% you have to achieve in 15 years time, so there is a much longer window, from RBI side also. Currently, no decision has been taken at either of these places. We will have to come to you once decision happens at the places and we decide, about next course of action in this case.
So just to follow up on that, is it safe to assume that it is not something which is going to happen in short to medium term?
Not in short term. I mean, medium term difficult because, if you even suppose, someone decides to go for it, it's around 15 months time. So it cannot happen in short term. But yes, medium is difficult to pick right now.
Okay, sir. Thanks a lot.
Thank you. The next question is from the line of Vijay Karpe from Shriram Life. Please go ahead.
Sir, thank you for giving me this opportunity, and congratulations on the strong listing. My first question is actually on the collection efficiency commentary that was made earlier. Actually, I missed the commentary. The collection efficiency has come in at 97%, and we have put about a number of 98.5. You could just explain?
So if we just break this 97% collection efficiency between, let's say, the regular or standard customers or the NPA pool. So collection efficiency for the standard pool is about 98.5%, and NPA pool, obviously, it is about 30%. So the combined collection efficiency is 97%, but if we look for only, let's say, the standard pool, it is close to 98.5%.
Okay. And going forward, we expect this collection efficiency on an overall basis to improve?
Yeah, we expect that. I mean, again, it's subject to a lot. But the way we are seeing traction in the market with clients, we expect to at least 0.5% next 2 to 3 years, 2 to 3 months time, sorry. 0.5% in next 2 to 3 months time.
Okay. And I also wanted to understand what is the mix of borrowers in terms of vintage. So the disbursements that we are doing, how much of it is going to the old customers who have seen 2-3 cycles of disbursements, and new borrowers, both in terms of disbursements as well as the UM as well?
So in terms of if you see the first cycle and the subsequent cycle mix in terms of number of customers, so as we said that we started focusing on new customer acquisition from last year. So right now the mix is about 30-70 with respect to let's say the new customer and the subsequent cycle customer in terms of number of customers. And if we let's say see the cycle-wise breakup, so right now the customers are there in about 2+ loan cycle are about 70% of our total portfolio, and 1 and 2 is about 30%.
Okay, great. And my last question is to the reverse merger. So, with the last question answered, to the reverse merger process, we have not started it, because if we have not started it yet, then it will still take 18 months, right? So, when are we expected to start the reverse merger process?
So as I mentioned that, it is based on boards of, both companies and investors. That decision is yet to be taken. It's not that we have started the process. They are contemplating, they are exploring whether, what are the other options and when to start and whether start or not to start. So a decision is yet to be taken on start. You are right. It may take 18 months once it is decided, but still 15 months time normally takes to complete the whole process. Broadly speaking, that decision is yet to be taken. So I think maybe when the investors and the board at places take a decision, then we'll be able to tell you the timelines it can actually take.
So when can we expect that decision to be taken?
At least not this quarter. Normally my sense is and I think this in next 2 to 3 months time. That is my sense.
Okay. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was our last question. I would now like to hand the conference over to Mr. Govindji for closing comments. Over to you, sir.
Yeah, thank you. Thank you very much for all of you and to attend this on behalf of Utkarsh Finance Bank, the board and the management. You have always been helpful and supportive of the institution. We have tried to build a very good institution out of Varanasi, and we see a lot of opportunity in terms of this space where we are operating from. And you must have seen in terms of governance, transparency, in terms of overall performance, we have been among the ones or the best ones in the industry over a period of time. And that is what I can assure all the investors that continue to do that part. If you have any follow-on query questions, you can come to us directly or through ITEC also you can come, and we'll be more than happy to respond to you. So once again, thank you very much for attending this call and for putting your faith in Utkarsh and the management. So once again, thank you very much and see you very soon again.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us. You may now disconnect your lines.